Now we just want to look at what's happening around the world because, yes, the U.S. has a lot of data and there's a lot of things that we could talk about, but there's also other places in the world that are huge demand drivers. And really what is happening with the global oil supply. You know, the U.S. is obviously a big piece of it, but there's a larger world out there that we have to look at and understand in terms of some of these key demand drivers. So when you look at the EIA, they still see a surplus despite the OPEC cuts. And the reason why is because of, you know, what are those cuts and what are some of the different increases. So when you look at OPEC, you know, as we've been saying, Russia was going to disappoint on the cuts because it's a matter of not so much what is production doing, but what are exports doing. And Russia has not only maintained exports, but you've also seen exports increase, especially on the refined product side, which we'll talk about in a minute. You know, but realistically, when you look at the underlying balances, you know, the EIA is at plus 0.4, you know, OPEC is at minus 0.6, IEA is at minus 0.7. So it doesn't take much to flip things, especially when you look at the demand side and the issues that continue to strike. And by the issues, I mean, you know, when we talk about manufacturing, industrialization, the industrial side of the world, you know, as we looked at it from the macroeconomic perspective on our econ show, you know, there's been additional slowdowns. And one of the things is a lot of this, the IEA actually came out again and said that, you know, China is going to surprise to the upside, and it's just the data doesn't say that. The data is not saying they're going to surprise to the upside. If anything, the data is saying the opposite. And I think the biggest place that people miss looking at China is the industrial side, because industrial never really went down even during peak lockdowns. Was there going to be a bounce on gasoline? Absolutely. Was there going to be a bounce in airlines? Absolutely. We still think that is the case. Our critique on people's view of China remains the industrial end, which we think is going to come under growing pressure. And so far, the data coming out of China supports that. Like, we're not making this up. And as you heard with some of the different things that we'll talk about, you know, we've been wrong before on things. And you know, when we look at the data has to say, look, are we right? Are we wrong? You know, one of the things, you know, as we talked about with U.S. gasoline, we thought there was going to be a bigger pullback after Easter. There wasn't. Again, that data was confirmed based on service activity, the PMI service activity, the activity when you look at some of the spending that happened. We had to adjust our estimates. You know, right now, when you look at China, everyone, you know, sometimes people are trying to push a narrative. It's like, look, you know, it's okay to say, based on this data, we have to kind of put some of these views on hold. And that's something that we like to look at, especially when we're always reviewing, because there's monthly, weekly gut checks. And, you know, as the saying goes, as new data becomes, you know, I'll change my opinion as new data shows me I should change my opinion. So maybe we'll turn around next week and say, oh my God, China's off to the races. It's just based on what we're seeing, what we're getting. That's not the case. And that continues to still be the case. Now, when we look at China, and this is the other thing, because remember, China has a lot of storage capacity, and they're going to be opportunistic with what they purchase. Here, when we look at China, smaller Asian refiners are seeking alternative feedstocks because they can no longer, or if they are holding to the G7 commitment, they're not buying Russian fuel oil. So China's like, oh, you're not buying it? I'll take that for you because it's at a discount. It's priced to sell. Let's put it this way, straight up, Russian fuel oil is super cheap right now. And China's like, all right, I'll take it. Like, I have nothing against this. And India's going to do the same thing. You know, VGO or vacuum gas oil is a key component for diesel, some of these pieces, which is why when you look at, and we talked about it in our insights, China increased the export quota, you know, versus last year. So again, it was down quarter on quarter, but it was way up year on year, and that's because there's a lot of product that's going to be pushed out, and they still haven't used all of their export quotas. So there's going to be more out there, and the fact that they're taking in so much of this cheaper product is going to give them an opportunity to turn around, turn this into diesel, turn this into something that has a different flag. And that's where we want to take a moment and talk about Iran. So Iran Novak has come out and said that Iran is looking to purchase more Russian product. And people are like, well, why would they do that? It's like, okay, twofold. One, if Iran buys more Russian product, it means that they can sell, they don't have to run their refiners as hard, and they can sell more crude into the market, especially because China has increased a lot of their buying of Iranian crude. And then on the other side, if they buy Russian refined product at a discount, they can then sell their refined product to Iraq, who then turns around and sells it as Iraq. And again, it's just, if you want to call it oil laundering, if you want to call it refined product laundering, the goal is to change the flag on the ship and then it gets accepted. So again, this is just more ways that you're increasing the cost of products, you're increasing miles per ton, but it's still going to the US, it's still going to Europe, it's still going to G7 nations, just by way of a different country. But again, same molecule. Because if I had an Iranian diesel, Russian diesel, US diesel, Saudi diesel, all in the same container, all measured as ultra low sulfur diesel, each molecule looks the same. So again, if Iraq sells it as Iraqi, you can't say, oh well, this half of the gallon is Russian. You'll never know. So when you look at the Middle East, floating storage is moving higher. Again, this is what we were talking about when you looked at activity from China. China is sitting there saying, we are not paying OSPs at these levels. They've been increasing Russian product and they've been increasing Iranian product. Why not? It makes a very big increase in terms of some of the flows. And the headline that just came across is ConocoPhillips returns staff to Alberta site as wildfire managed. Again, back to segment 1 and 2, where we were talking about the increase in some of these flows coming into pad 2 just because the wildfires are starting to be contained. But again, back to the Middle East. So because of this, China's like, well, I'm going to take my term. Everyone's going to take their term product, but I'm not going to buy excess. I'm not going to pay that. West Africa's at a discount. Iran's at a discount. Russia's at a discount. I'm not buying excess, and that's going to, again, keep these prices elevated, and that's only going to change if, again, Saudi cuts their OSPs. When you look at the 4-week rolling average from the U.S., again, exports remain elevated. We had another record going into Europe. We still have a lot going into Asia. That's not going to change. When you look at Gasoil cracks in Asia, again, as we said, a bounce, and now it's kind of chopping around. We do see that fade. What the comments we made about U.S. Gasoil still holds true here. You're going to have refiners coming back from maintenance. You're going to have them ramping up to meet some of the gasoline demand or that summer runs. And as the industrial side continues to struggle, especially in Asia where it's struggling, but it hasn't weakened as much as the developed world, this is going to, again, drop down. And we do believe that 10 level is going to be hit by July. When you look at some of the swaps that break down between ICE first month Brent and Dubai, you can see that things have the discounts are starting to widen for Dubai, and it's just because there's this supports what we've talked about, builds in storage that's going to try to discount things to move some of these products over. Global crude oil on the water remains at a near record level. Obviously, 2020 is higher. We still see that remaining sideways just because there's a lot of crude out there, and especially on the water, not as much Russian product going through pipe. Iran getting a bit more aggressive in that market, and here you're seeing more of this product moving in. And it has to get there somewhere, and it's getting there by boat. And you can see that we have now remained elevated. As we said, we will stay at the peak of 2020 is where we're going to live at this point going forward, just because of the amount of product that continues to move. And again, with that product on the water, and this is what we talk about for a moment, because we want to, again, bridge some of the gaps that we've heard from people when you look at floating storage. Some people have said, transit doesn't matter. So I'm going to say that isn't the case right now. And the reason why I'm going to say that is because there's so much crude on the water and there's only so many slips. You're going to do what's called slow steaming, which means that you're going to have the different ships that are going to travel at a slower pace. You're then going to have ships take different routes. You'll have some go through the Suez Canal. You'll have some go through the Panama Canal. You'll have some go the long way because you have to space out these deliveries. Otherwise, you'll get a huge surge in floating storage, and it's expensive because you're paying them to sit on a boat. So you space out some of these levels. So while I understand the comment on transit, because there's so much in transit and because they're trying to manage these flows, it does matter. And that's why land is staying a bit lower and floating storage is going to stay elevated. The transit's going to stay elevated. And as we've been talking about, as this product moves back into location, floating storage is going to remain at that 2022 level. Now, when you look at Asian floating storage is starting to creep back up. We do see this again going back to the 2022 levels, not going to 2020 levels, but it's going to be that marrying of taking advantage of pricing, might as well, and the fact that they can turn around and sell that product, the refined product, at an increasing clip because of the elevated, the estimates for the Chinese export quotas was between 9 million tons and 13, and the final number was 12. So again, very much elevated. And here you can see that crude, supertanker crude imports bounced a bit. Some of this is Iranian, some of it is Russian. And again, if you have access to the cheaper crude and you can sell at these crack spreads, you're going to try to take advantage of that, and that's what we're seeing now. But because of that, that's going to take away some of the product demand from other Asian refiners, which is why we've been talking about that balancing act, because as Chinese product goes to market, the demand for Asian product, other Asian refined product comes down, putting some of that pressure on right there. Now, following the Chinese congestion, you can see that there is a bounce following 2022. But remember, 2022 had lockdowns tied to it. And there was another one following especially in Beijing and some of these others, following Golden Week. So when you look at Shanghai, Beijing, you get a bit of why the levels in 2023 are going to be above 2022, because even though 2022 was better than normal, you can still see that two of the biggest, most populated areas were in lockdowns. So that's why this one, where when you look at Beijing and Shanghai, they're normal now. So here you can see that's elevated, and that's going to be the differentiating factor. You can see that it's following the seasonal pattern, but it's going to be at a shift higher from what it was in 22, which is what we've been saying. I mean, 2022, they had lockdowns. They don't have lockdowns now. Therefore, demand's going to be higher than it was. But one of the things that we were saying is that there's only so much more demand you can have, given that the levels that are being looked at are against 2019. So again, it's just, when you look at these pieces, there's only so many cars you can fit on a road. There's only so much demand you can get, which is why I think that there's not enough gasoline demand to offset the losses on the industrial front. When you look at refinery utilization rates, it continues to trend up. The Shandong are at 62.1. They're going to continue to move higher. And again, it's as they come out of maintenance, as they start to ramp up. And you can see on average, this is when they start to increase. So nothing surprising there. West Africa made a new seasonally adjusted high. And there's been a stark slowdown following kind of that strong. So West African flows had a great end of April, a great first 5-7 days, first week of May. And then things kind of fell off a cliff. And that's what we were saying, is that, things were going really well. We saw that drop. But then things started to slow down, and now the slowdown has only intensified as China has been opting for other grades, and you're not seeing a huge increase in buying from Europe or the US, which is why you see that seasonally adjusted high. And really, West Africa sitting at 2022 levels. Here, when we look at some of these different pieces, product exports. So gasoline had a small increase of 170,000 barrels a day. It's 163,000 above the 5-year average. Distillate fuel oil had a small drop of 42,000, still 234,000 above the 5-year. We want to look at some of those different levels. Propane, small drop of 25,000, but again, well above the 5-year. That's going to remain. And then crude, when you look at, last week it was 2.87. This week it's 4.3. Again, we're just essentially going to sit at that, what is effectively the structural limitation, because there's still so much demand that's going to continue to fly off into the global markets. When you look at gasoline, you can see that there was a counter seasonal increase. Typically there's an increase, but it's on a downward side. Here you had a nice big spike. So one of the things is we expected this to move along the 5-year average, but the PADD 3 refiners are going to try to manage their exports and manage their storage between what goes through Colonial, what goes into the export market. We still see a downside. Is it going to be slightly above the 5-year? Maybe. Right now we're still going to hold to, this is going to kind of hug the 5-year average when you average it out, because there'll likely be a correction to the downside, but these are going to be some of the things to watch. Distillate had a bit of that counter-seasonal exports. This is where we do think there's going to be a sizable reduction, but there's a lot of these are bought weeks ahead. So some of these purchases happen prior to that big increase of Russian flow. So that's why we do see a sizable amount of product again coming back down. So now when we start looking at oil exports, again, staying at the high end, we don't see that changing. When you look at propylene, again, still going to stay very elevated. Same for ethane, we don't see that changing. Some of the cracks that we've talked about are really in Fujairah, and this is kind of where we see the cracks kind of growing from here. So when you look at Fujairah, there was a build of 1.737 million barrels. That takes us to 24.9 million barrels in storage. Again, there's just a huge increase at this point. Light distillate had fell 1.086 million, but it's still just below 7 million barrels at 6.88. East of Suez gasoline complex continued to weaken as participants expected another increase of Chinese exports, which we did get. The market expects China exports in June and May to rise to about 1.3 million tons, up from the estimated of 800 to 1 million in April. So again, as we've said, the Chinese product is going to take market share, which is why Fujairah is going to kind of show the cracks. And as things build, it's because China is displacing product, which is going into Singapore, which is then displacing product into the Middle East. And that's kind of how that knock-on effect continues. So the fact that it's already this far back is showing, again, how that pressure is only going to mount going through pretty much all of June. Middle East, the middle distillates increased 1.18 million. It's now at 4.56 million barrels. The East of Suez ultra low sulfur gas oil structure flipped into backwardation. So we're still getting some of that movement, but again, there will be fewer volumes from SK and S oil in June because of planned maintenance. So the question is going to be how much of that Chinese product takes the replacement, and that's why I think some of the market is expecting storage to drop. My expectation is that China kind of fills that void and the market doesn't drop the way it was expected, putting some of that downside pressure and really kind of capping some of those crack spreads. Heavy resid rose 1.643 million. Came in at 3.457. Again, sizable increase, but it was also down last. This was the highest since January and reversed 3 consecutive months of declines. And a lot of that is just based on some of the slowdowns on the shipping and bunkering side. When you look at Brent time spreads, as we've been saying, they're kind of sitting in this kind of this backward level. So again, it's still back in backwardation, but as you can see, it's getting tighter and tighter. Now, when we look at flows, again, Norway has increased to 1.6. No surprise there. Nigeria holding steady at that 1.27, 1.3 level. Angola just over 1 million. Now, the bigger issue at this point is West African light sweet crudes are struggling to find buyers as competition from, again, those cheap Russian cargoes, Iranian cargoes are eroding that Asian market share. India only took about 5% of West Africa's crude exports in Q1, which is down from 15% before the invasion. So again, that's a lot. Chinese share fell from 35% to 25%. That's a lot of oil that is being left in the market. French refiner strikes obviously created other issues. And then these factors have continued to keep a lid on spreads with Bonny Light declining versus North Sea. Again, a lot of problems. Heavier sweet Angolan crudes have been more resilient, but even that has come down. And there was actually a lot of commercial use of South African oil storage, which was West African barrels being kind of stuffed in there in Q1, and they have not come out. And then when you look at additional pricing, and we continue to see, so Unipec offered 950,000 barrels of Angola's Olombendo for June loading at 25 cents less than dated Brent, and previously it was 35 cents plus dated Brent. So again, there's a large shift in general, and we continue to see those slowdowns keeping weight on the products. Crude in floating in onshore storage came down slightly in Europe based on the floating trends. We see this again kind of shifting up. But if you look at 2022, it normally bounces, and other periods it normally bounces. So again, we're not talking about anything too seasonally adjusting. Gasoil had a build of 109 when you look at some of the, had a build of a bit higher than that. I forgot to update the top end of that chart. Had a build of 143. So again, sizable build, a lot of that coming in general, and that's where we see some of these increases. Gasoline had another big build. So again, as these builds continue and manufacturing activity, construction activity remains in the doldrums in Europe, and again, it's in contraction, multiple months in contraction, we're going to see Gasoil continue to build, reducing their purchase of U.S. gas oil, U.S. distillate. And again, that's kind of that, again, moving the opposite direction that moving in that direction we've been talking about, and those knock-on effects capping U.S. exports. Gasoline surged above highs, again, well above, seasonally adjusted all-time highs, moving to the highs of 2023, which is the highest they've ever been, which is why we've talked about that continuous flow of European product into U.S. Fuel oil surged to the highs. The only time fuel oil storage this time of year was higher was in 2020. So again, it's just there's no demand because you have all that cheap Russian product, which is what we've been saying, taking market share, pushing more of this product back. The total fuel stocks in Europe, in Singapore are at the 29, about the 18-year average. But again, it's not all is created equal. Light distillate surged back to all-time highs, coming close to the 2023 highs once again. We see gasoline as a big overhang. Middle distillate had some of that pull down. We do see some of this reversing, but this is again driving some of that support. But as we walk through the different issues, that's not the different issues when you look at some of this backdrop of Chinese product pushing into Singapore, pushing into Southeast Asia, pushing into Singapore, pushing into Fujairah. There's going to be pressure here. And then Resid had a nice drop. But again, this is kind of that waffling back and forth. We do see this reversing back up. North Sea floating storage, kind of bouncing around the bottom. There's enough demand at this point just based on the cheapness of North Sea versus some of these others that you're seeing some of these stable flows. And then when you look at Europe, a little bit of a bounce, still at the higher end of floating storage, which is why we see more land storage coming our way in Europe. So that's what we have for you today. If you have any questions, please feel free to reach out because we'd love to hear from you. And we hope you have a great rest of your day. Thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.